Good. All right, welcome once again. This is SeeWing Yee from the Yee Real Estate Network. And my special guest once again is Richard Advani, who is a real estate mortgage consultant. And Richard and his company, Supreme Lending, does loans, investment loans to investors on all 50 states. His company, Supreme Lending, also do regular loans in California or anywhere else even for owner-occupied buyers. So with that in mind, Richard and his staff is our primary investment loan agents. Whenever our investors try to buy in the areas that we're promoting, then we would do our best to send our investors to do the financing for 20 to 25% down payment with Richard Advani and his staff. So the topic of today, without further ado, it'll be approximately a 30-minute video podcast. We try to make it short, concise, and comprehensive to provide good content, to provide real life, reality, accurate, authentic content in a way that we think, coming from our personal and professional background over the years. So, and also potentially dispel any kind of, misinformation that's happening out there in the real estate world. So I know a lot of you are, maybe watching YouTube videos about real estate investing, and there's a lot of misinformation out there. So we are going to talk about first, the first topic we're going to talk about, Richard and I, how this historic interest rate environment, how this is helping many real estate buyers. Not only that, then we're going to clarify and define the true definition of a real estate crash, a real estate correction, and real estate bubble. So without further ado, Richard, since you are in the mortgage world, you follow the Federal Reserve, you follow the Treasury. That's what you do. That's your job. And clearly, you understand why we are at a historical interest rate environment. So with that in mind, Richard, can you share with the audience how we come into a place right now in this 2021 and beyond, how we came about, how this interest rate, tremendous interest rate, such low rate, and that's why it's really one of the main reasons the real estate has gone so well as it has in the past, year or so. So, okay, so take it away, Richard.
Yeah, thanks, SeeWing. Good afternoon, everyone. Richard Advani here. As SeeWing mentioned, I've been in the mortgage business for 15 years. We've really specialized in working with investors for much of that 15 years. So we have a very aggressive team that's licensed nationally. We can assist with primary homes and rentals and so forth. But kind of jumping into it, as SeeWing mentioned, interest rates right now are historically low. And I know we've been hearing that historically low for the last 8 years. We did hit the low of the lows last year, about 12 months ago, where, you can get an investor purchase or refinance loan in the mid 4s, and primary homes were in the high 3s. And those were fantastic rates. I mean, those were the lowest they had ever been. And what we've seen what's happened since, and really since the start of COVID, is, as those treasury bonds moved down, with them, the mortgage rates dropped even lower than the historical lows. So we started seeing primary homes as low as, the mid 2s, and investment properties in the mid 3% range. Now, I know a lot of you have, if you've been paying attention to the news in the last 7 to 10 days, interest rates along with that treasury bond have spiked. Everyone's saying sharply, but in all reality, you can still today, even with that increase in the market, get an investor loan in the mid to high 3% range, which is still, even though it's gone up from the low of the lows that it was at up until a week and a half ago, it's still at a point that it shatters the previous record in the mid 4s that was here a year ago. And it's still a great time, obviously, to take advantage of those low rates. As SeeWing may have mentioned, things are getting more and more competitive out there. The real estate market's booming right now. And with those higher prices, not only as on our primary homes, but in most, if not all of the investment markets we work in, we've also seen the prices go up. And we're at a unique time right now where, the lower rates have kind of made up for that price increase and still allows us to get those ROIs that we were looking for as investors, or even if you're looking for a primary home. I mean, getting a rate under 3% versus, a year ago, they were 1% higher. That equates to $100,000 to $200,000 more in purchase price for the same payment that you would have had before. So, it's a unique opportunity. Rates are still obviously extremely, extremely low, although they have moved up a teeny bit from those lows. The general consensus is, hopefully the increase we saw is going to amount to a lot of the increase that's going to happen this year. We're hoping the treasury bonds as well as interest rates stay relatively consistent from here on out. That way the rates still stay attractive. But in all reality, I mean, even if rates moved up another 0.25%, which would put investor rates, at 4%, let's call it, that's still historically low and that's still great. So I don't think that's going to make a big impact to whether or not us as investors are going to buy a home or not. 0.25%, 0.375%, 0.5%. Most of the margins we're dealing with on these properties are a little higher than that.
Very good, Richard. That's a very good high-level explanation. So what I hear you saying is that because of the challenging aspect of the pandemic and COVID-19 and the economy, at a very low point, but we are seeing some good positive news with respect to the vaccines, and there are 3 vaccine company are they're trying to people try to get vaccinated by the end of this summer, and hopefully the economy will pick up and will come back to some sort of normalcy. So so because of that, I'm sure you'll agree that the interest rate are not going to go up dramatically, because if the interest rate goes up dramatically, then the not only the economy will be affected, but the real estate market will be adversely affected as well. So I don't think the Federal Reserve want to increase the rate too much more, given the what's going on with the with the economic environment right now. Is this correct?
Yeah, I definitely would agree with that.
Mm-hmm. Good. All right, now let's talk about, okay, again, what I found once again is just these days with the social media, with the advances in technology and the internet, many people have access to information, right? I mean, it's really information overkill. So we can dispel a lot of misleading information and a lot of, talk out there. So we can talk about the 3 big words, okay? The words are real estate crash, real estate bubble, and real estate correction. Now, before we do that, before I will solicit Richard's response, right now we are clearly, I mean, real estate have done very, very well since the pandemic began back in early 2020, in March 2020. And the main reason are, again, we go back to the low interest rate has really motivated many buyers to get off the sideline. And then the low inventory that have seen historical low, lack of supply, huge demand. The huge demand comes from people migrating from one area to the other area. We've been hearing the mass exodus and mass huge migration of people from big cities like San Francisco and LA and Chicago into mainly Texas, or people from the New York City and New Jersey and Northeast migrating toward the southern states and the southeastern state, mainly in Florida. So we've been seeing that as a result, because of people not selling their homes during the lockdown and the tremendous demand with the low interest rate. So we're seeing. I know every market is different in the U.S., right? When you talk about real estate market, it's not nationwide. It's is local. Real estate is local. But speaking from my perspective, in the area that we're promoting in Florida and Texas mainly, we're seeing like multiple offers. I mean, we're seeing, like, for example, in Austin, Texas, one of the areas that we're promoting, I've seen recently like there were about like 90 offers, 100 offers for one property. I mean, I have never seen this ever before in my lifetime. This is just one example. Like, for example, a single family home in Austin, like selling for like 200,000. It got a few days later, it got listed for 200,000, but it sold for like 275,000 or even 300,000. Another typical scenario in Austin recently, whereby a nice home for 500,000, listed for 500,000, it was sold a couple of days later for like 650, maybe even 700,000. And one other example on a luxury real estate in Austin, some homes were listed for $1 million and they were sold for like 1.3 million. I mean, we're talking 20%, above list price. I mean, this is crazy. This is just one example of a specific market. I know Austin is a little bit different. Is on fire, but the other market, you may not get, such a high multiple offer situation or even a 20% above list price, but maybe 10%, 15% above list price in other markets, especially in the South and Southeast. So some people are thinking, because of this, the risk is not going to increase by 15 to 20% appreciation every year. It has, this cannot be sustained long term. So some people using this very negative scenario, they say real estate is going to crash in about next 12 to 18 months. There will be a massive foreclosure going to go on. Personally, I do not think so. Personally, I do not believe there's going to be a crash because Richard will address this. I do not believe there's going to be a crash. It's because it's not like 2008 crash. The 2008 crash mainly arise from bad loans, bad mortgages. And this time we do not have any of those things. So let's go over the definition of real estate crash. What is your thoughts and perspective on the potential of a real estate crash, Richard?
Yeah, so, obviously this is my opinion, but as you stated, firstly, fact-wise, the last crash that happened, not only with real estate, but the whole economy was directly related to mortgages. And the fact that, anyone with a heartbeat and a pulse and a semi-decent credit score can go and buy a house, a lot of times without even showing any income documentation or any assets. So, clearly that was heading for disaster. And I would say what's changed today is, with Dodd-Frank and with QM and all these other kind of safeguards put in place to prevent us from going to where we were, 10 years ago, but also to prevent the lenders from, just completely going nuts. People who qualify and who have taken out mortgages on homes these days are qualified. They go through a rigorous process. They have to prove, obviously, the means to repay that debt. And there's pretty strict standards. So, look, at the end of the day, are foreclosures going to happen because people were qualified for a mortgage that they shouldn't have got, or because the mortgage interest rate went up and they had a balloon or they had an adjustable? In my opinion, no. Because people who got loans in this last 8 or 10 years are qualified. Most of them are fixed rates. A lot of those predatory loan products don't exist anymore and haven't existed for a long time. So, in general, in history, obviously real estate has markets of expansion and contraction. And, we've definitely been in a pretty long expansion period thus far. And, the values keep pushing higher and higher in markets all across the country. But that doesn't mean necessarily that there is going to be a crash, because firstly, some of those big things that led to the real estate crash of 2007, 2008 haven't happened anymore. But also, there's a lot better fundamentals in terms of the people that are buying this real estate. So, at the end of the day, if the economy is going through broader troubles and people lose their jobs, can that affect their ability to make mortgage payments? Sure, of course. If the whole country goes into a recession, it will be a little more difficult, obviously, and foreclosure rates will go up, but not to the scale of what we saw before. Because once again, what happened before was real estate was the major cause of that crash. And, because there were so many people that got loans they shouldn't have got, when there was a slight turn in the economy and they weren't able to make those payments, there were so many chips that fell at once. So I don't really see that as being likely this time around. Now, also historically, we'll see that real estate every 12 years, over 12 years, whether there's a crash or whether there's a correction or a recession, real estate inherently does go up. It's just about those interim periods where it may cycle down for a little bit. So in my opinion, I'm hopeful, obviously, that the market is going to stay strong. But look, if there is a 10 or 20% correction in the market in the next year, 2 years, 3 years, first thing I ask myself as an investor is, well, what does that mean for me and my portfolio? Well, it doesn't really mean anything. I'm not trying to sell any of it. It's all long term. So at the end of the day, if someone says, hey, the property's worth 10% less, it doesn't mean anything to me really in that regard. Another thing to look at too is, people need to look at real estate much like, any other investment, much like stocks. So, if you own a bunch of Apple and Apple drops 30%, you can either panic and sell all your Apple and take the loss, or you can buy more Apple at that lower price and dollar cost average. So, a lot of people ask me, because I have, 18 properties, firstly, am I still buying properties? And also, what are my thoughts and or concerns about, a crash or correction or values going down? And, one thing is you definitely want to have reserves and be capitalized, right, to absorb some loss of rent. But at the end of the day, if the market goes down, it just, to me, means an additional buying opportunity to bring my overall cost down on the properties and actually to invest more.
Yeah, absolutely right, Richard. You have explained the real estate crash in a very, very practical, very realistic way. So that's a good explanation. Now, and you also explained about correction. Crash, correction, bubble. Too many people think in such a derogatory way. So you have to put it into the right perspective. So yeah, real estate. No one have a crystal ball. But if you think long term, right out the storm, as long as you buy a property that cash flows, just focus on getting the renter, getting the cash flow going, and just invest for the long term, right? Real long term. So asset allocation and all that stuff, using real estate, buying different locations, because every local market in real estate is different. Now let's go over the correction and the word bubble. We kind of discussed about the correction. Look, I'm not saying that we're going to have like 20% appreciation for the next 4 years. It may not happen. Yeah, we are seeing some very high appreciation in certain market, as I discussed already. But it'll subside once there are more inventory, more supply of homes that come into the market. Once the pandemic get back to normal, like hopefully later this year, more seller will finally put their house in the market, because they will not fear about the health risk of people walking inside the house, right? With the COVID-19 situation. So yeah, we expect to see more supply, more people, more sellers will put their house on sale for the next year or so. But even that's happening, because right now is such a big disparity between supply and demand, between low inventory and high demand. Even when there are more supplies coming in inventory, and even when there are more new construction, more builders gonna build more new homes, they are really in a catch-up mode. We're not gonna see a balance between supply and demand. This is the fundamental of economics. If the supply equals demand, then we have an equilibrium. We're going to have a normal real estate market. But I do not see, based on the data that I've seen so far, even before the pandemic, that the supply is such a low amount of inventory. It takes a while to catch up. So I see appreciation for maybe double digit, maybe 10, 50% for another year, maybe another 2 years. Then, 3 years from now, that we may have a so-called correction. The word correction is not that bad either. It's not doom and gloom. Correction means 3 years from now, we're not going to see 10 to 15% appreciation. We may see 5% or even 0% appreciation, which is fine. You're not going to lose value on a home that you have built up on a house that you bought today for the next 2-3 years. So some investors are thinking, oh, I'm going to stay on the sideline, right? I'm not going to buy until the market is normal. And then I buy 3 years from now. I mean, the cost of waiting could be catastrophic for your real estate wealth building, because if you buy now, for example, and your house increasing 30 to 40% in value for the next 3 months, you have already earned your equity the first 3 years of holding the property. So the cost of waiting, for some of you are over analyzing, some of you have a lot of fear. You're thinking, oh, all this, I'm going to wait until the market crash so I can buy real estate at a 40% discount, some ridiculous notion that you may have. So that's a wrong way to do it. It comes from fear. Like, your fear will manifest itself by justifying your fear by overanalyzing that the market, you think you're playing an amateur economist that you are. It's not going to happen. It's just the philosophy is buy real estate and wait instead of wait to buy real estate, still hold true in today's market. So I know I'm talking so much, so we only have about 7 minutes remaining. So Richard, can you kind of, you don't have a crystal ball either, but yeah, tell me, what are your thoughts as to what I just said about correction and bubble? Some investors want to wait for the reasons I just stated. Some investors that understand the current situation it is, they have done all the research. The smart investors have done all the research data. Timing is right. They can pull the trigger right now when the price is still low, because prices are still rising, especially new construction, right? The cost of lumber is skyrocketing, so the new construction builders are increasing their prices on a regular basis. So now is the prime time, to get in now before things gonna get worse for you. So, what are your thoughts?
Yeah, I mean, that's a good question, and something we get faced with pretty often in terms of when is the right time to invest. And there are a lot of people, as you know, that have sat on the sidelines and continue to sit on the sidelines. And, I have investors that we had this conversation with 3 years ago. They've done nothing. And, as recently as a week ago, had the conversation again. And now they're like, well, it continued going up. And, now it's definitely not the right time. Well, they thought it, wasn't 3 years ago. And, the values have gone up 35-40% since then in some markets. So, the right time is now, firstly, in my opinion. You can get caught waiting on the sidelines your whole life. And, a lot of people, it's kind of, they get stuck in analysis paralysis. And, even the biggest hedge fund managers, Ray Dalio and stuff, will say, don't try to time the market, right? Dollar cost average, invest consistently. That way you're buying high, you're buying medium, you're buying low. And at the end of the day, you're actually in the market, though. You are earning a return versus sitting on the sidelines, earning 0.4% in a Wells Fargo savings account. Even if you don't buy it at the right time, between the cost, the positive cash flow that you're going to buy it based off of, as well as the tax benefits and everything else, it's still going to be better than doing nothing, right? Can you make a 13% rate of return on a property by buying it at its low point versus a 8% rate of return or 6% rate of return today buying it at high point? Sure. And would all of us love to get the 13%? Absolutely. But guess what? While you're waiting, you're earning 0.5% in a savings account. So, in my mind, the time definitely is always now to act versus waiting. And then also, as you said, a bubble versus, a correction. I think a bubble is kind of something created through artificial, unsustainable demand. And, as a whole, is where the real estate market is today. By today, I mean up until even the last year. Was that a bubble? No, the economy is doing well. Real estate overall, the real estate market has been improving. There's qualified buyers coming to the table to buy. And there's a lot of qualified buyers based on these new regulations that are coming to the table, and not as much supply. So I don't really see what's happened to real estate up until the last year as a bubble. Now, are we in a small bubble within the grand scheme of the real estate market because of COVID? Yeah, as you mentioned, actually, rightfully so. There's so many people afraid to have other people come into their house and list their homes that right now there's so many buyers in the market, but probably 25-30% of the sellers are actually comfortable with listing their homes and having people come into their homes and going through that whole home selling process. So that has created a little bubble that will probably, I wouldn't say pop, but it'll probably subside by the end of the year as more and more sellers are comfortable putting their homes on the market, which will mean, there may be closer to enough inventory for the buyers. But even prior to COVID, it was still extremely competitive. There were still 5 to 6 offers on every home. The difference is today there's 50 or 30 offers on every home. So it's a 10x bubble in the short term. But even once this subsides, the fact that, there is limited inventory all around the country, there's people waiting in line to buy homes. You pair that with the low interest rates, even if rates went up 1%, rates are still extremely going to be low, even at that point. And the fundamentals that's driving the demand for the homes, I think overall is strong. There are people that are qualified for the homes. And there are people that, in most situations are well apt to succeed in home ownership, even if there is a slight contraction to the economy and everything else. But, once again, I think, most millennials, for example, or people in that age group have only seen one crash in their life. And it was, 10 years ago. And it was because of real estate and because of mortgage, rather, that caused that crash. And, a crash, I think, once again, is because of, factors that are creating a temporary situation, like the fact that 12 years ago, they were handing out mortgages like candy. That's not the situation, I think, currently. The growth has been steady. It has been consistent. It's had good driving factors. And I mean, look back at 10 years ago, 20 years ago, 50 years ago, ask anyone a house that they bought, your parents, your grandparents. I guarantee it's going to be 3x higher today. Now, does that mean we've been in a bubble for the last 30 years? No. Inherently, real estate and other investments are going to go up, and they are going to continue going up. And yes, they're going to cycle in between. And yes, we all want to catch that. What? I got a call that came in that kicked me out. Yes, we all want to catch the bottom of that cycle and sell it at the top. But, and that's amazing when that happens, but that shouldn't be the basis and foundation for your investment. If you catch it at the great time, great. But if you don't, if you buy a cash flow property today and the real estate values drop 10% next year, and even if rent drops 10%, guess what? You're still going to be positive cash flow on your investment. You're still going to be earning more than a checking savings account and a CD in most situations. And at the end of the day, you're only going to assume losses when you sell something, right? So, if some of the properties I own today have gone up very sharply since I bought them 6 years ago. But that means nothing too, because I'm not trying to sell. So I haven't gained anything until I sell, and I'm not going to lose anything. So even if in 2 years they lose 30% of their value, it still means nothing to me, because, I'm looking at an exit strategy of 15 to 20 years from now. So I try not to pay attention to too much of the noise in between, personally. But once again, if market drops in 12, 16, 18 months, at some point there is going to be a slight reduction, a correction. But our price is going to drop 60% like they did on the last real estate mortgage induced crash. I think that's highly, highly unlikely. Can they drop 10, 15% in my opinion? Sure, absolutely. And is it better to buy when they're 15% lower than higher? Sure. But if you already knew how to time the market, you would already have, whoever this client is standing on the fence, they would already have millions of dollars worth of real estate. But they don't know how to time it. Neither do I. Neither do you, SeeWing. We all do our best, once again, to buy at the bottom, sell at the top. But standing on the sidelines accomplishes nothing. So I say, if you buy consistently, if it's 1 a year, if it's 3 a year, whatever's comfortable, then you're buying at the bottom, top, the middle. And at the end of the day, you end up right in the middle, and you're able to take part in the healthy growth of the real estate industry, which is not the bubbles, not the cyclical stuff, just the fact that, hey, there's more and more human beings. There's less and less land on this world. Inevitably, supply and demand is going to dictate that real estate in the long term continues to move up. At least that's my 2 cents.
Wow, Richard, you surprised me. Your explanation, your high level analysis, it just resonates with me and everybody else is listening. Very well said. I like your brief mention about Wells Fargo savings. I get that. Wells Fargo. Anyway, okay, let's not digress. So yeah, so yep, the big picture is yeah, take action because we can all, the final thought that I have is, I mean, a lot of investors are continuing to be educated. That's fine. I mean, so too much education, too much real estate education without action is really worthless. So until and unless you take action, nothing is going to happen in your life. So the key is, I mean, you need to increase your net worth. You need to increase your real estate wealth while you're sleeping. And the best way to do that is by remote, passive, turnkey investment methodology that I'm promoting. So, so I know, there are many ways about real estate, but I just share with you the best way, my way. So my way or the highway. Oh, just kidding. All right. So, well, anyway, time is almost up. Thank you so much, Richard. You're not only a mortgage advisor, you are a, wealth advisor, for the value to provide. I mean, when you do loans for our investors, you look at the big picture, right? You're not doing one transaction. You're doing a relationship type of business where, that's why you get a lot of repeat business from many sources, not just my investment club. So because you understand the goals and objectives of your of your clients. So I really appreciate that. Working with you as a team, it has been great. So because of you are in the mortgage industry, you understand economics, you understand interest rate, and all those key metrics that people need to learn in order to achieve real estate wealth. So we can bring you back in the future. Of course, there's always more topics to discuss. Thank you so much for your time, Richard. I know you're very, very busy doing multiple loans each and every single day. Thank you so much. Thank you, everyone, for attending. Thank you, Richard Advani from Supreme Lending. This is SeeWing Yee Real Estate Network. Thank you so much. Have a blessed day. Good night. Goodbye.